the bank had lost the game. It was game over for the bank.
The shorts get a punch in the face, but they come back for some more. You could almost imagine seeing him saying at the time, Hi, welcome to another Super Macro podcast. My name is Elvis, and sitting opposite me is ex-hedge fund manager and the author of the Super Macro Note, Jonny Matthews. Hi, Jonny.
Hi, Elvis. How are you?
Okay, sir. How are you?
Yeah, good, thank you.
There's a couple of things I want to talk about today, Jonny. The first one is the non-farm payroll print on Friday, which was negative 23,000, with revisions to over 100,000 losses over the previous 2 months. Yet yields are climbing. Treasury yields are climbing again.
Yep.
The second thing I want to discuss is the coordinated action to support the yen from the US and the Japanese authorities. Yet the dollar yen has rebounded 3 big figures.
Well, let's just briefly run through the payrolls. It's been analysed to death by now. As you rightly said, there was a loss of 23,000 jobs, but 50,000 could be accounted for by state and local education. And that, I think, is just a seasonal adjustment issue around the school holidays.
Right. You mentioned that in the note.
Yeah, absolutely. There were also job losses in leisure and hospitality, which is unusual because that's been that has been a source of strength over the last year or two.
Well, the PMIs have been strong recently as well, the service PMIs.
Yeah, exactly. So it doesn't really make sense that there are job losses in that sector. It's 1 month's payroll print, so we'll have to see. But in addition, pay growth slowed down to, that was quite
0.1 on a month, wasn't it? And was it 3.3?
Well, I don't remember the exact number, but pay growth slowed to, I think, something close to 3%. But more importantly, the unemployment rate dropped to a new, I think, 13-month low, down to 4.1%. So we had net job losses on the month, and yet the unemployment rate declined because the supply of labour has shrunk. Fewer people are now registered as unemployed because they're not looking for work. There are fewer people looking for work.
So the boomers and the net zero migration.
I think it is, yeah. Retiring boomers and less net migration. So you have fewer people that are part of the workforce. The workforce participation rate declined. And so those people that don't have jobs, when you take account of how many people don't have jobs, fewer of those are actively looking for work.
So why isn't the average hourly earnings
Well, that's kind of strange.
increasing?
You're right.
Bearing in mind you've got less pool to choose from.
Yeah, I'm surprised. I suspect that if the unemployment rate stays this low or goes any lower, you will see average hourly earnings beginning to increase.
So you're not a fan of Walsh's idea that AI will give us productivity and wages don't have to rise so far because AI will take over.
Well, that's we don't actually see the impact of AI within the sectors that are most exposed to AI replacing human workers. Not yet, anyway. So there isn't much evidence of those productivity gains in those sectors.
Okay.
But let's not dwell too long on the payroll print. I'm, more focused by what's going on in the Treasury market. As you rightly said, Treasuries rallied initially and then gave up the gains. And in fact, yields now are much higher, well, quite a bit higher than they were prior to that payroll print. So what is going on? Well, I think the problem is Walsh would like the Fed to keep rates fairly easy. Besant would also like to avoid a rate hike by the Fed. And I think if we look at this chart...
Oh, yes.
If you look at the maturity profile of US debt, you can see that the bulk of it matures over the next few years, which means that any rate hikes will feed through to the interest costs.
Directly affect that.
Yeah. That debt needs to be rolled over more frequently. And so when it comes up for when it matures and gets reissued by the Treasury, it will be at a higher interest rate if the Fed hikes.
So there's a definite incentive to keep rates as low as they can.
Yes, to keep rates low and to keep on issuing in the front end of the yield curve. And, well, it's interesting.
Someone's got to be paid somewhere along the line. There's no free ride. There is.
Well, there isn't. And it's interesting because Besant previously criticised Yellen, for increasing the share of short-term debt in short-term debt within the mix of total Treasury issuance. But he's carried on the practice. Something like 22%, over 22% is now issued in short-term debt. And, of course, the more you have in the short term, the more you really want the Fed to hold rates low, subject to the long end remaining anchored. You really don't want to see long end yields going up and up and up.
It just feels like the way that the US is going is that they're just a little bit behind Japan, but they're just trying to create their own world of what they want without the market actually clearing these prices. In other words, we don't want the long end to sell off, so we want those prices to stay more elevated, not the yields to come down. But we don't really want to do anything about spending at the front end. We want to spend as much as we want to spend.
Yeah. You mean issuance at the front end? Yes. Look, the deficits are still 5 to 6% at a time of pretty much full employment. Believe me, if the unemployment rate goes up to, if the
what are they going to do?
If the economy slows, the deficit will blow out into double digits without a doubt.
Jonny, the US is a financialized economy. People's wealth they look at and they spend according to how wealthy they feel. Do you feel that the risks are greater than they ever have been for if there is a recession coming? What will happen to prices? Well,
yeah. Look, I'm not worrying about a recession at this stage of the game, but yes, I mean, household wealth has gone up enormously as a result of house prices creeping higher. Bit by bit, households are paying off their mortgages. There's, I think, something like 40% of homeowners own their homes outright.
Right.
On top of that, we've had a massive equity rally. So household wealth now, as a ratio to overall income, is the highest it's ever been. And I think that is a factor behind the incentive for aging boomers to retire. They've got the wealth. They can just, tell their boss to stuff it and, start spending the wealth that they've built up.
Do you think this is why the authorities are very quick to intervene when they think there's any sort of like hump in the road that they've tried to get over, because they're so worried about the fact how, I wouldn't say delicate the system is, but the system's relying on everything else going up and everything else does go up.
Well, in the past, there has been this concept of a Fed put that Walsh wants to get us away from. But I think if push comes to shove, believe me, the Fed will step in again. Yeah. But let's not dwell too much on that, because I really want to talk about what you mentioned, the intervention, the coordinated intervention in the end.
And the reasons why.
Yeah, and I think in all honesty, Besant, the US side of things is not really doing that much. But Besant really doesn't want the Japanese to start selling their treasuries to fund to raise dollars to then go and sell dollars and buy yen to support the yen. He'd rather they just hang on to their existing stock of treasuries.
So he lends them the dollars. Yeah.
Well, no, it's not so much that. He's just trying to do everything to make the market realize that, it's a coordinated effort between the US and Japan. And that's what gave that recent intervention, that, the extra push. The fact that the market saw, okay, the US is on the same side as Japan.
It moved 6 big figures, didn't it, at the end or something? Did it move 6?
Well, it came down from let's put it this way, it came down from a 4-decade high, right the way down from, what was it, almost 164 down to 155 something.
Oh, so it's even more,
almost,
9 big figures.
Almost 9 figures. But I think in reality, I don't think Besant is actually doing that much. And this I just thought was ridiculous. This is...
Schoolboy.
Yeah, bit of smoke and mirrors. Besant has allowed a Reuters photographer to capture a shot of his so-called to-do list, a hand-scribbled to-do list, while he was in a meeting. And he was, at the time, if you look at a different photo of this meeting, he's sitting around a massive conference table. There's about 20 or 30 other people around there, photographers and press all around the room. And he's supposedly, inadvertently, allowed this Reuters reporter to get a picture over his shoulder of this notepad that says, buy Japanese yen, in brackets, JPY.
So he knows. Sorry to remind you what it is.
5 to 10 bill, just so that everyone knows. And
it's like you could almost imagine seeing him saying at the time, please do not photograph what we got on the desk. Do not photograph this specifically.
But he didn't stop there. He didn't stop there. He's made a big deal out of this coordinated intervention. He actually instructed the Fed to sell euros from its...
the New York Fed, wasn't it?
Yeah, to sell euros from the... Exchange Stability Fund. I believe there's about $220 billion worth of foreign exchange reserves in there. So it's quite a large fund, but obviously it's not unlimited. But he sold euros to buy yen because, of course, the US has a strong dollar policy. We
can't be seen to be selling dollars to buy yen.
No. Not only that, he also pledged to do whatever it takes to support Japan.
His name's Draghi, yeah.
Well, that's where the phrase came from. But, it's a very different situation. Europe was facing literally an existential crisis.
Catastrophe, yeah.
An absolute catastrophe where it was potentially staring down the complete breakup of the monetary union. And at that point, it was realistic to take Draghi at face value. He would do whatever it takes to keep the union together. And so once he'd made that commitment, that was all the market needed to hear. I mean, in Besson's case, this is all just smoke and mirrors. We can see he's got an ulterior motive for saying, we're going to do whatever it takes. He also said he would encourage the Fed to increase the limits on the FEMA facility. Now, this is just a facility that allows foreign central bank counterparties to borrow dollars by pledging treasuries.
Yeah, swap treasuries for dollars.
Yeah.
Let
me just be clear. First of all, there are limits. I think it's $60 billion per day per counterparty.
Right, okay.
But most of the counterparties that would have signed up to this already have swap lines with the Fed.
Right.
They don't need to.
So why use that?
If we look at chart 3, this is actually the FEMA use over the last few years. It looks like it's been used once before in 2023, and whoever used it kind of maxed out the day's use with 60 billion of usage.
Looks like one and done as well.
Yeah. There are swap lines where basically, let's say, for example, the Japanese want to borrow dollars to sell into the market and buy yen. So
they can borrow them off. They can borrow dollars off the US, give them yen, pay the difference in the yield, and then hopefully reverse a trade when things calm down.
Exactly. The Japanese would print some yen, post it at the New York Fed, borrow the dollars.
Pay the diff.
Yep, but it's a swap. And ultimately, it has to be paid back. So the only way that they would be able to pay it back is by unwinding the trade in the market, the dollar-yen FX trade.
Assuming it's gone the right way.
They may be able to unwind it or pay back the dollars some other way.
Well, how do they pay it back if they're not
by
prepared
selling treasuries?
By selling treasuries, yeah. But more the point is, they want to get the dollar yen, they want to get yen higher, but without reform to the policies they've got, how on earth are they going to do that?
Well, that's quite correct. But from Besson's point of view, I think he wants to keep the illusion going that there is this joint coordination effort taking place.
The two big elephants in the room are doing what they want to do.
Yeah,
And
to warn off speculators
Yeah.
from continuing to run the carry trade. But as you rightly say, the overnight rate in the US is 3.63%. The overnight rate in Japan is 1%. That differential,
you've got to pay it if you swap it. And,
it's not. That's what the speculators are. The carry trade punters are. They're happy to take that differential. Plus, they've got the momentum behind them.
Yeah.
If we look at chart 4, where you can see the stock of FX reserves held by the Japanese, they are beginning to make a dent in those reserves.
But it still looks healthy, though, doesn't it? The amount of reserves they've got, and they can continue. If they've really got the political will for it, they can use a lot more to prop up the yen.
Maybe. I mean, it was 1.17 trillion at the start of the year.
Right.
Dropped to 1.09 trillion at the end of July. And this most recent intervention effort is estimated to have, they're estimated to have used $87 billion. And you can see, the line is dropping quite fast. I think, they've got firepower. They can shift dollar yen a few more figures if they put their minds to it. But I think once speculators see that the FX reserves are being drained, it'll be like a green flag to them to really push the boat.
But if they use the repo facility that the Fed's offering them effectively, that won't affect the amount of FX reserves that they've got, because it's borrowing the dollars for and pledging treasuries. So they could start doing that if those reserves got to a level where they were uncomfortable.
Absolutely, yeah. But like we said before, ultimately the dollars have got to be repaid somehow. But just getting back to your earlier point, is what they're doing sustainable? I think the Japanese, or Takaichi, the administration, the primary objective is to keep nominal GDP growth high to reduce the debt burden. And Fitch, earlier this year, I've got to just refer to my notes here, but just to put this in perspective, Fitch in January affirmed Japan's credit rating, single A. And at the time, you can download the report. They said that they expect the fiscal deficit to rise towards 3.7% of GDP by fiscal year 27 from 1.4% in 2024. Okay, so they expect the deficit to continue widening, but they still forecast the debt to GDP ratio would decline from 222% in 2020. It's got down to 200% in fiscal year 25, and they see it going down to the mid 190% by 2029.
Because of nominal growth.
Because of high nominal GDP growth. That is the best way out of the debt trap. You've got to keep nominal GDP growth high, but you've also got to convince investors to still buy your long-dated bonds.
So what's the shock absorber? There's got to be something. You can't just get it. Doesn't that?
So
if that was a blueprint, everybody would be doing it. There must be something that gives.
Well, in this particular case, I think it is the currency. But as we've discussed previously, Japan is trying to persuade the administration would like the BOJ to hold rates low, 1% below the rate of inflation. But the administration is also providing fiscal stimulus with all these energy subsidies.
Yeah.
Trying to persuade the GPIF to increase their allocation to JGBs.
They don't want the market clearing the price, do they?
They're trying to keep a lot of plates spinning.
Yeah. And
they're suppressing the rate of inflation with these energy subsidies. But inflation is creeping higher. And you're right. What's the relief valve?
I said, from a trading point of view, it's very difficult to bet against, first of all, the Japanese and the Americans acting in unison when it comes down to the yen. But there's going to be a time where it's going to work for you. You can see, you don't necessarily do it now, but over the next few months, things will develop.
Yeah, I think you're right. Because at the moment, the way it's going is, if we bring up chart number 5, and you can see, dollar yen kind of creeps up. It's on this steady upward drift. But every so often, there's a round of intervention that sets it back 3, 4, 5 big figures.
The shorts get a punch in the face, but they come back for some more.
But eventually they come back. And not only are they earning the interest rate differential from this trade.
Yeah.
They've also got the momentum behind them in the actual spot level. So I don't think you're going to completely clean out the speculators from this trade. If anything, they'll be emboldened, as I said, once they see the Japanese FX
even with
reserve.
two powerful central banks or two powerful administrations working to keep the yen at a level.
Yeah, well, it is very, very difficult for a country to support its domestic currency, as we found out in the UK. When the UK was part of the exchange rate mechanism, I'm sure you're old enough to remember this, Elf.
Oh, thank you so much.
This was 1992, I believe I read, and
that's against Deutschmark, wasn't it?
Yep, that's right. It was pegged to
Not that I remember, of course.
No, we've just read about it. The Bank of England was committed to buying as many pounds as it took to keep sterling pegged at a level within a band against the Deutschmark. And
Q Soros and Q, was it the drunk? Wasn't he working for him then?
Yeah. And I remember at the time, I think it was 290 was the level, if I remember.
Around that, 280 something. I was about to say 280 something.
Well, the Deutschmark had strengthened to 288 to the pound. I think the lower band was 290, but it had strengthened. Fewer Deutschmarks needed to buy the pound, 288. And it wasn't supposed to be below that lower limit. And it was quite obvious the bank had lost the game. It was game over for the Bank of England. There's only so much FX reserves they can expend fighting it. So ultimately, I think the Japanese are going to have a very, very tough time supporting their currency while they continue with these policies that they have in place.
I don't quite get why they can't raise rates maybe to 1.5% gradually. I don't mean at the snail's pace they are now, but I mean another quarter coming at the next meeting and maybe another quarter, 2 meetings later. What's the deal? 1.5% is not much to.
Yeah, I think
it's not onerous, is it?
Well, the administration is really populating the whole policy-making board with doves, bit by bit. There are 2 hawks on that committee, and the minutes of the most recent BOJ meetings showed that a member suggested a faster pace of hiking. I mean, it would have been one of those 2 hawks.
Was he taken out and shot?
Their term expires in less than a year, those 2 hawks, and they will be replaced by doves. But I don't think the BOJ is going to speed up the normalisation.
Are they sort of set in this mould of looking for the last 2 to 3 decades where they struggle, 2 decades where they struggle to get any growth and any inflation, and they're so worried about a quarter point or half a point rally
it's like I said, the name of the game now is high nominal GDP growth. They had a lost decade.
So you borrow loads of money,
decades.
get yourself in a mess, and then create a lot of high nominal growth,
GDP growth, and you get out of the mess gradually, bit by bit, the way they're doing. As long as
the currency,
I think a weaker currency is a price they're willing to pay. More importantly, they need to ensure the long end JGBs don't become completely unanchored. And if we look at chart 6, there we go, chart 6 in this deck, you can see, the trend in JGB yields.
It's just been, it's like an accelerating trend.
Yeah, it doesn't look healthy.
Yeah.
5-year JGBs just hit a almost 2-decade high. The 10-year is still hovering near that 2-decade high. The 30-year, it's come off its peak, but viewed from a longer term perspective, they all look like they're heading vertical.
This is a product of the policies that they've got, isn't it?
Absolutely. And what concerns me is that I think the US, to some extent, I'm not saying it's heading down the same route, but
it seems to be on that same road.
It's
maybe an earlier
earlier
stage.
on that path.
Because this is the the problem is there's going to be no reform. No one politically has got the will to cut out what they pay out and what they give away. And therefore, deficits are going to be high, always remain high. That's all there is to it.
I think you've hit the nail on the head. It's a question of what you can achieve politically. And when it comes to cutting entitlements, it's very difficult to do.
So if that's the case, Jonny, this is the only playbook available at the moment.
Realistically, I think this is the playbook. And so for me, it's not so much the size of the US deficit. People have been worrying about that for decades. I think the debt clock was first put into Times Square, I think it was 1989.
Yeah.
And then around the turn of the century, they had to replace it with one with more digits.
We've run out. We need more zeros.
So it's just going, and people have been worrying about it for literally for decades. But what I think, what is more concerning for me, and why I think Treasury yields can go a lot higher, is that the globalization couple of decades ended with the pandemic, and now we have frequent supply shocks, poor fiscal discipline. We have a restricted supply of labor. Inflation has been above target for years. Inflation expectations are well anchored at the moment, but they may not be. And we've got a Fed.
Yeah, and bond markets are just starting to react to this as well now, aren't they?
Yep. And if we look at my final chart,
yes.
Chart number 7, you can see that Treasury yields, and I've said that these thresholds, 4.5% for the 10-year and 5% for the 30-year, previously acted as a cap. When I say previously, I mean over the last few years. But now they seem to be more like a floor on these yields. And if you zoom out, and I don't have the chart in this deck, but if you zoom out and you look back to where these yields were prior to the financial crisis and in that earlier decade, they were much higher.
Yeah.
And I just think that is the kind of, not the new normal, that's the old normal that we're going back to. 2010
was the abnormal.
Yep. From the
GFC.
Financial crisis, that was the abnormal period. I've said this before. We had a decade of ultra-low rates, ultra-low inflation, central banks struggling to get nominal GDP growth higher, and things changed.
So tell me, do you buy what Walsh has said, that the financial markets have done some of the Fed's job for them already?
I think that's a very dangerous statement to make. I mean, that is like a red rag to a bull.
Yeah, of course it is,
Yeah.
So the markets will do your job for you.
Yeah, and they will carry on doing your job. So, look, I mean, we're recording this on Tuesday. This will air on Wednesday, shortly before the next CPI.
The inflation report.
The July CPI report. I think the market is going to be intently focused on the core measure, which is expected to show a further moderation. I'm just worried, I think the risks are asymmetric around this, in that, okay, if it slows, maybe treasuries will rally a little bit. But if it's a worse print than expected, I think it could be, you could see some very sharp.
He'll be under pressure. He'll be under extreme pressure, isn't he? Or more pressure, rather.
Well, I think it's the long end of the treasury market is going to be under a lot of pressure. But yeah, I mean, listen. After this inflation report, we've got one more jobs report and one more CPI report before the September meeting. But if you just look at it from the labour market point of view, the summary of economic projections at the June meeting was forecasting an unemployment rate of 4.3% at the end of this year. We're down at 4.1% and heading lower. So the labour market, at the moment, is not the issue. Inflation is the primary issue at this stage of the game, and that's why a bad print would be quite severe for the treasury market.
Okay, Jonny, could you just briefly, like 2 sentences sort of thing, summarise what we've discussed today and what your thoughts are?
I think in the US and Japan, the long end of the market is I won't say becoming unanchored, but the yields are moving higher and higher, and I don't see that policies are in place to bring them down again.
Combat that, yeah.
That is the bottom line, really.
If anybody wants to read in more detail your thoughts, where can they find you? Where can they get hold of you?
super-macro.com. I write a daily note. You can get a free subscription for 30 days, and then it's £50 a month. Each day, I summarize the day's economic data, what it means, what the implications are. And then on the weekend, it's a deeper dive into the markets and what I think is going to happen.
With your portfolio as well.
With my portfolio in there as well.
Thank you, Jonny.
Thank you, Elvis.